Oh, wait, you weren't recording him that whole time? Ladies and gentlemen, good evening. It's about 5 minutes to 6 on Thursday, the 25th of February. Welcome to Symmetry Financial Group Debt-Free Life with Senior Analyst Scott Forehand. Want to thank everybody for being here. You were either invited by someone, you're either someone who works with Symmetry or invited by somebody who works with Symmetry. And Scott's an expert at explaining how this whole thing works. I know we're getting a little bit of a later start, so I wanted to just go ahead and kick it right over to you, Scott. And thank you very much for your time tonight.
Thank you, Mr. Deutsch. Welcome, everybody. It is, again, as Tom said, the 25th, about 5 minutes before 6. My name is Scott Forehand. I'm an agency director here at Symmetry Financial Group, and we're here today to talk about debt-free life. So let me go ahead and start sharing my screen, and we can get going. And here we go. So welcome, everybody. Debt-free life. What is debt-free life? So debt-free life is a proprietary program from Symmetry Financial Group. It uses a couple of financial concepts that we rolled together. One is called infinite banking, which if you were here for the introduction with Mark a few minutes ago, you heard that phrase before. Also uses a concept called debt snowballing, and we'll talk about that in a few minutes. But debt-free life is, again, a play on words. It's using debt to free up your life. We're using debt to build your life. We're using debt to build income streams. We're using debt to eliminate debt. And this is something we're going to talk about in just a second. So welcome. So debt-free life, when we first start doing these programs, one of the things we're all taught are these two simple questions. Are you 100% sure you're going to have a great retirement, or do you have some doubt? And the other question is, what if I could show you a way to get out of debt in 9 years or less, including your mortgage, without spending any more money than you're spending today? And about that second question, what I'm seeing is that really is not the case. 9 years or less certainly is doable in most cases, but the reality is it's actually 15 to 27 years early, because I've seen people with 30-year mortgages that we've gotten them paid out, fixed their mortgage, paid off all their debt in less than 3 years. So the reality is it's going to be 15 to 27 years early, not just 9 years or less. So moving on. So if you're the average American, just like I was a year ago, then this basically accounts for your dollars. About 34% of your money that you make is spent paying interest on whatever debts you have. About 40% of the money you make over time is spent on taxes. Excuse me, taxes, whether it's income tax, property tax, luxury tax, whatever, it's taxes. And about 3% of your money is spent on savings for the future, which is certainly, if you're doing that, it's better than 0%. And finally, 23% of whatever you have left, 23% is whatever you have left. And that's what you're using for your lifestyle. That's what you're using to pay your mortgage, to pay your car bill, put gas in your car, put food on the table, keep the lights on, and maybe if you've got money left over, pay your Netflix or your Hulu bill. The bottom line is, this is not what our founding fathers had in mind when they started this country. This is not where we're supposed to be. It just happens to be where we are. And if anybody has any illusions that saving 3% of their annual income is going to allow them to continue with the lifestyle they currently have while they're still working, you need to reevaluate, because that's definitely not the case. So what we're going to try to do is we're going to try to change things around, change the paradigm, change the game a little bit, get it back to closer to where our founding fathers wanted it to be. So most Americans in their lifetime are going to earn about $2 million. And most Americans, if you're looking at that 3% number, most Americans are going to have about $60,000. When you're in your last years of work, your last useful years of employment, typically you're talking about ages probably 50 to 60, maybe 55 to 65. Those are typically your highest earning years. So if you're accustomed at 55, 65 years old to earning 120, 180,000, and all of a sudden you're done, and you've only got $60,000 and you're relying on Social Security, you got an issue. And that's hopefully that's one of the reasons why you might be here, because this program, these programs that we have, this debt-free life program, can fix that for you. So what we want to do is not this. This is when you talk to someone, especially if you're in debt, talk to them about how to get out of debt. What do? They're going to say, work harder, get a second job, spend less, go eat tuna fish and ramen for a while. consolidate your debt. All those things are going to fail at some point. You're not going to be able to eat tuna fish and ramen for the next 2 years. You're not going to be able to refinance and then refinance and then refinance. You're not going to be able to spend less for very long. The only one of these solutions that works with regularity is the debt snowball. And as long as we're talking about true debt snowballing, not debt stacking as some of the other programs that are out there would teach. So what we want to do is we want to change the paradigm. We want to move to something that works. This is what we want to do. We want to take you from the left side of the screen to the right side of the screen. You want to change the amount of taxes you pay over time, 30%. That's a 25% reduction in the amount of taxes you're going to pay over time. That's huge, because we're not talking about making more money. We're not talking about getting extra jobs. We're not talking about being a Walmart greeter on the weekend and then maybe working your regular job. That's not what we're talking about. All we're talking about is changing the way you spend money, spending it more efficiently, putting you into a situation where you can have your money work for you as well as with you. Okay. And then critically here, we want to reduce the amount of interest you're going to pay over time. We want to increase the amount of money you're saving for your retirement. And here's that kicker, that 23 to 33% delta. We want to move you from the 23% side, where that's where you are right now. We want to move you into a 33% scenario where you're saving 33% of the money that you're making, where you're able to have 33% of the money you make, 1/3 of every dollar instead of 1/4 of every dollar, able for you to use for your lifestyle. So if you maintain your lifestyle, just think about this for a second. You maintain your lifestyle. Let's say at the end of every month, you've got $1,000 left over. Okay. What we're talking about is a 43% increase in disposable income. 43% increase in monthly cash flow. That's what this program is going to do for you. So if you save, if you spend your money and you work your business and you do your thing and you have $1,000 left over in your checking account at the end of every month, all we're talking about doing is changing so everything's still paid, everything's getting paid off, but instead of you having $1,000 left over every month, you've got $1,430 left over every month. So we're talking about changing your cash flow in that scenario, increasing the amount of money you've got left over every year to do whatever you want to do with it by about $5,000. And for me, $5,000 is a big deal. And hopefully for most of you, it is too, unless you're Paul Bine and, $5,000 is, it's $5,000. Let me get my wallet out. So as we move forward in time, our goal is going to get you to be able to change your lifestyle money, to be able to change so that you've got more money left over every month. Your cash flow is increased. But not only that, how do we get there? We reduce the amount of taxes you're going to pay. We reduce the amount of interest you're going to pay. But one other critical thing here to look at, that scenario we went to just a second ago, where someone who made $2 million in their lifetime has $60,000 left over at the end in savings, right? That's a 3% number. What we're talking about is increasing that number by 500%, and that's critical. So I'm going to change that person's scenario from $60,000 in their savings, in their retirement savings, to $300,000. That's a completely different and much more tenable position, especially if you think about other streams of income. All right. So moving on. How do we do it? We're going to eliminate your debt. How? Because debt is evil, especially student loan debt. You're going to hear me say that. I pound the gavel on that one all the time. We're going to reduce the taxes you pay every time. I just told you that. We're going to improve your cash flow. Just told you that. We're going to allow you to retire with a tax favored income. And when we talk about tax favored, there's taxed favored. We're also called tax advantaged and tax exempt. I'm going to go for that one. And that's what this is. If you use this program correctly and you access funds in this program correctly, it will be a tax-free event. Okay. So this is not new. There are other programs that have come before us, other programs that are out there currently. And I'm not going to say any of their names because I don't want to advertise for them because they're all faulty. Okay. One of the main reasons why most of them fail, and they all have reasons, they all have an Achilles heel, but one of the reasons why most of them fail is because they make an assumption that is, which is incorrect. They assume you're not going to have an emergency at some point. So the system that we're doing here builds in an emergency fund. What does that mean? That means there's going to be money hidden in your program. You're not going to see it. It's there though. and we want to make it really difficult for you to get to it. So when that emergency comes up, Paul Bine, that emergency that you need to go out and buy that new jet ski, that's not really an emergency. We don't want you to take that money and go grab it. Right, Tom Deutsch? So as we move forward, we want to make sure that we understand there's a 20% emergency fund that's hidden in the program. It's there. You can use it. You can access it if it's really an emergency. And we want to make it painful for you to get to it. That's why it's called an emergency fund. Moving on. When you compare these programs, this is what I was just talking about a second ago. Tax-free versus tax-deferred or tax-advantaged versus taxed, right? If you compare these three programs, then one's a 401k, one's a Roth, and one's this. That's the tax-free program. And the reason why, if we're looking at the same type of investment, the same $10,000, running over the same 28 years of up and down with the market, earning a 7% interest average with a 25% tax rate that you're going to pay on the money that you made. In our system, you cannot outperform the system as long as you're taking the money in the tax-free manner that we're going to show you how to do it. There's no way the math works. And I say this a lot, it is not magic, folks. It is just math, and the math doesn't lie. And when you're looking at these programs, your contract with the carrier, hopefully mutual trust, your contract with the carrier is going to be the Bible, and your contract with the carrier is in stone. And your contract with the carrier cannot be adjusted by any outside force other than you and the carrier if you both agree that you want to adjust it. So the point is that, we have a lot. I get a lot of questions from people about, well, what's going to happen with the new administration? How are they going to address this? What's this going to do? How's this going to affect my program? And the answer, I'm going to point everybody back to something President Obama said years ago when the big ING debacle happened where the federal government bailed out ING, and all of a sudden they received $50 billion bailout, and now all of a sudden all those executives were leaving the company and taking those golden parachutes. And when President Obama was questioned about this, he said, which is the same reason why this is protected for us, he said, I can't do anything about it. It's a contract, and the federal government does not have jurisdiction over a contract. So in this scenario, once the contract is in place, the contract's in place. Once the contract is written under the governing law at that time, you're grandfathered. So if things change next year, you're good to go as long as your program is already in place and in force. So let's move forward. This is at its core a life insurance program. However, realistically, it's a life insurance program as well as a financial product, financial service program. So when we look at financial programs, typically they operate in phases, and this program is no different. Let's talk about the three primary phases. The first primary phase is the maximization phase. That's the phase when we're going to maximize the amount of money you've got coming into your program by eliminating your debt, by putting you into a situation where you can put more money into your retirement program. Okay. So as you're putting more money into your retirement program and you're paying off your debt, the debt snowball, which is simply taking one debt, paying it off as quickly as you can, and then having the minimum payments from that debt start coming back into your program and snowballing. Think of The Grinch Who Stole Christmas, that cartoon that I grew up with when I was a kid. And you've got that little dog with a little fake antler tied onto the top of their head, and they get over the edge, and then all of a sudden he comes down, and he trips, and then they're rolling and they're rolling, and the ball gets bigger and bigger and bigger. That's what we're talking about doing here. So once that debt snowball is built and you've completed the maximization phase and you are debt free, which is going to happen 9 years or less, 15 to 27 years early. I like that one better. So you get out of debt. Now all of a sudden you're in the accumulation phase. So what is that? So the accumulation phase is when you have maximized your annual contribution to your program. Maybe you're putting in extra money, came up with more money. In theory, you've gotten some raises. Maybe you want to put more in. That's fine. We're going to make room for that. But you're maximizing the amount of money you're putting into the savings program. The beautiful thing about these programs, folks, is they are not governed by the IRS regulation of when you can access the money. They're not governed by the IRS regulation of when you have to access the money. Required mandatory distributions doesn't exist here. Okay. Finally, when you're done and you get to that time, 50, 55, 60, 65, whatever that age is for you, and you no longer want to pay into the problem, you don't have to. depending on how you structure this with the agent or broker underwriter that brought you here. You don't have to. You can set it up so that all of a sudden you're never paying another premium. But the program, because of the guaranteed interest and that dividend, that program is going to continue to grow. That's the distribution phase. That's when you can go out and buy that emergency jet ski. You can go out and get that brand new four-wheeler. You can go out and take that emergency trip to Tahiti whenever you want. Okay, so that's the phases of our program here. Maximization is our debt elimination phase. Accumulation, that's where we're going to maximize the growth, complete the growth cycle to get to the distribution phase where we're no longer adding money to our program and we're simply taking money out of it. I mentioned this is not a new program. This program has been around for a long time. People have been doing this for over 100 years. The Rockefellers and the Rothschilds were the first group to do this. Previously, however, in order to do this at the level that we're talking about, you had to have a whole lot of money to be able to play this game. And these are some people that have done this in the past. Walt Disney, Doris Christopher, Ray Kroc, Warren Buffett does it to this day. The whole idea here is that I'm able to get to a situation where with regularity, I'm probably going to earn what's called positive arbitrage, meaning I'm going to be able to borrow money at a lesser interest rate. When you combine all the different things that are happening, I'm able to borrow money at a lesser interest rate than I'm being paid. So what we're talking about here is infinite banking. I'm going to make myself the bank. I'm going to make a life insurance program the bank. And I'm going to be able to borrow money from that bank at most cases a lesser interest rate than what I'm being charged to borrow the money. And when you couple that with the maximization and the accumulation process, along with that guaranteed interest rate that we have, along with the dividend, then eventually your debt gets paid down in short order. And we'll show you that in just a few minutes. Not only that, your debt, as in the loan that you have with the carrier, gets paid down fairly quickly. So let's move on. So we're going to use life insurance to do this. And there's a number of reasons. We were talking about this earlier before we started the recording, but basically we're taking advantage of the IRS tax code 7702. And if you're doing this as a business debt-free life program, you're also probably going to take advantage of IRS tax code 160. The idea with this program is we're going to redirect inefficiently used dollars. So if you're like my daughter and you go to Starbucks 5 days a week, that's an inefficiently spent dollar. So what I'm going to do is I'm going to buy her a Keurig. I'm going to give her some Starbucks coffee pods, and that's going to cut down the cost of her coffee bill on a monthly basis by half. So what do I do with that other money? I redirect it. I'm going to redirect it into this program. So that's a spending issue. The other issues might be maybe I've got a credit card bill that I owe $5,000 on, and my minimum payment is $150. And I've been paying $300 because I want to pay it down fast. So in that scenario, we're just going to capture that $150 that you're overpaying and use that as a funding mechanism for this program. We're going to allow the policy's cash to grow. This is a guaranteed growth, folks. It's by contract. It's not up for discussion. It's not up for guessing. You're going to get a guaranteed growth amount, and you're going to use the money when you need to use the money. We're going to be borrowing money for the policy's cash value. No penalties of tax. How? Because it's a loan. So when you bought your house, for example, did you have to pay tax on the $300,000 you borrowed to buy that house? And the answer is no. Why? Because loans are tax exempt. It's not income. The only time it's going to become income is if, for whatever reason, they decide to forgive your debt. They decide to say, yeah, you don't owe us $300,000. Then they're going to send a 1099, and that just became income for you. That's not what we're talking about here. We're talking about changing and using money from our program to help fund paying off debt to create that debt snowball. And we'll talk about that in just a minute. 9 years or less, we've already talked about that. Legacy. Yeah, let's talk about that. This program is designed to build a legacy for your family, not just your kids or your grandkids, but we're talking generational wealth if you do this the way the Rockefellers, the Kennedys, the Fords, Rothschilds, all those names, Chases, this is how they did it. This is one of the mechanisms they used. So I can transfer money in theory over time from one program to another program. I may pay some tax on it at some point, but the idea is I can create generational wealth and permanent growth if I want to. Moving forward, this is an old slide. This is when we first started this program back in 2019, and these were some of the first families that we were able to help. the money that they saved over time, 84, 73, 100,000, that's great. It's light. I have very few times have I run into any family with that kind of small amount of debt. So if you're out there and you owe $500,000 or more, don't worry about it. You're in good form because the rest of us are in the same boat you are. Okay. So let's talk about how you spend money for a second. And this is the key difference, trying to differentiate here what you do and how you spend money versus the way we're going to show you how to spend money. So let's say you work a job, you make money, 401, not 401, regular W-2, W-4 employee, 1099, whatever. It doesn't matter how you make your money, but you make your money and you deposit your money into your current bank, whether that's Wells Fargo, Citibank, Chase, whatever, SunTrust, whoever you bank with, it doesn't really matter. And then at some point, you realize that your money is sitting in that bank account. And that bank is lending your money out every night, because all those banks borrow money from each other to make sure they've got enough money to cover their role, whatever role they have on their books. They're making money with your money every night. This is not unknown. Everybody knows this. And the average dollar that you put into your account is lent out 7 times before you actually use it. How much did they pay you, Mark Creighton, to borrow your dollar and use your dollar? They paid you zero, most likely zero. Okay. So they're making money with my money over and over and over again, and they're not paying me anything. As a matter of fact, they may say, you know what, Scott, because you've got $2,000 in your account, we're not going to charge you to put your money in our bank to let us use your money without paying you anything for the use of it. That's their proposition. Okay. And so for me, that angers me a little bit. And I'm going to tell them to go pound sand. How? I'm going to do one of these programs. So let's talk about that for a second. So they've made money with my money over and over and over again. My money is still sitting in my bank account in theory, but it's gone until I need it. Has anybody ever tried to go deposit $10,000 or more at one time into your bank? And do you know what happened? How long did they tell you that you had to leave that money, or it had to be in limbo before you could actually use it? Probably 3 days. Where's the money? So either the company that paid you that money still has your money, or your bank has your money. Regardless of the answer, your money's missing for 3 days. Somebody's making money with your money, and all we know is it's not you. Okay, so this is what we want to get away from. We want to get away from that. Okay, the bank has control of my money, not me. Okay, and more importantly, that scenario I just gave you with the $10,000 deposit. Has anybody ever walked into their bank and asked to withdraw $20,000 or $10,000 or $5,000? Right? So, they're going to say, oh, we don't have enough cash. Oh, we got to get approval from the bank manager. Oh, whatever. They're going to give you 1,000 reasons why they can't give it to you that day. And they're going to make you wait. Why do I have to wait for my money? Okay. So I'm sorry, a little angry about this. Moving on. So at some point you decide that it's time to pay your debt. You decide that I'm going to go ahead and pay my car payment for the month. I want to send my car company, my car lender, $500. And so I tell my bank to go ahead and send that debt off, pay that debt, pay that $500 debt. I use my bill pay system. I write a paper check, whatever. It doesn't matter the mechanism, but you've instructed your bank to send money to a creditor. So what's really happened? In the money, once it leaves your account, your money has become their money, and your money is gone forever. And if you are nice and sweet and my wife, and you can bat your eyelashes, and you're beautiful, and you ask really, really sweet if you can have your money back, it ain't happening. They got your money. It's not your money anymore. It's their money now, and they're never giving it back to you. Okay? This is the way you spend money. You've used your dollar exactly once. The bank used your dollar 7 times, and in the end, the only people that have benefited from this, the creditor got paid, the bank made money with your money, and you got zero left to show for it. So there's a better way. Here's the better way. Everybody, you getting this, Mark? Taking some notes? All right. Here you go. Your money, same dollars, W-2, W-4, 1099, doesn't matter. Same deposit. You're going to take that money, your income, and you're going to deposit it into your checking account. And here's where the rubber meets the road about our program. Before that bank can lend your money out 7 times, make money with your money, and give you nothing to show for it, you're going to pay your life insurance premium. Yep, I said it. This is a life insurance policy, right? We talked about that in the very beginning, but it's a specific kind of life insurance. It's called participating whole life. And what this is, it's a whole life policy with two very specific riders that make this program do what we want it to do. We're taking a life insurance policy and turning it into a private bank. Okay. How do we do that? Well, let's say $1,000 is what we did. So instead of that $1,000 sitting in our checking account, we pay $1,000 premium to our bank. And the way we structure these, whoever your agent is or your broker underwriter is, they're going to structure how this gets split based on your goals, your needs, and what we're trying to do. So in this case, I'm going to have one of the riders that's going to be enabled is going to be a term life rider. How much is going to go to my term life rider? Very little. Okay, it's certainly a minority portion of what your monthly payments are going to be, but it's a minority portion of the payments, but it has a massive effect on what we do with this, and I'll explain that in just a second. And that third part of what we do here is this: buy paid up additions, and that's the magic, folks. If there is anything, my $1,000 when it hits the carrier, it's really being split into three components. Part of it goes to whole life, part of it goes to pay for my term life rider, and part of it goes to my paid up additions. What's the split? For me, the split I typically use is 68% paid up additions, which means almost 2/3 or more than 2/3 of the money that you have is going to buy paid up additions, which is our private bank here, folks. And the remaining 1/3 is being split between term life and whole life. What I see here in the average is about somewhere between 8 and 11% is being spent on term life, and the delta of 32% is being spent on whole life. So let's talk about that for a second. Whole life, right? Whole life policies have one really cool character, which is they build cash value over time. Okay. This whole life policy is no different. It builds cash value over time. So a portion of the money that we're spending that's going towards that whole life piece is building cash value. Cash we can have access to, not just the bank. The bank's the paid up additions part, but it's cash, real hard cash. That's an emergency fund we're talking about. We mentioned earlier, right? It's there. Can you get to it? Yes. Is it easy to? Maybe. Do we want you to get to it? No. We don't want you ever to touch the cash value of the policy. Okay. So now what's happened? Instead of the bank making money with my money every night, that $1,000 that I've got in my checking account, I've moved it up into my primary debt-free life bank, my personal bank. And what's happened? That cycle where they get to make money with my money every night and not pay me anything for it, I'm now making money with my money every night, and I am paying me for it, and nobody else is taking the money for it. So what have I done? I've moved my money into my bank. Okay? This is critical. This is a thought, right? So before, my money went into the bank kept the money, made the money, then paid my debt. $1 in, $1 out, no gain, right? So now what am I doing? My money in, my money into my primary bank, I'm earning 4% plus a dividend every year, or in this case, for mutual trust compounds monthly. So I'm earning 4% monthly, not 4% monthly, but a portion of 4% monthly, compounded monthly. And then at the end of the year, it gets credited, and now I've got a bunch more money in my account than I started with. But what happens when I got to pay my debt? I got to pay that credit card. I got to pay that car payment. What do? Take a loan, right? So we talked about this before. This is tax exempt because it's a loan, because we don't pay taxes on loans, right? So I take a loan. I borrow against the value of my program. I take a loan. It gets deposited into my checking account. I then tell my bank to go ahead and pay my debt. And then what happens? They get their money. My creditor's paid. But what really happened here? Where's my money? My money is still sitting in my DFL bank. I didn't use my money. I used the carrier's money. I used a loan from the carrier. And remember, we talked about this earlier, positive arbitrage, right? Over time, that loan's going to get paid down by default, whether I decide to pay it or not. But if I do decide to pay it, then I'm going to start cycling through my money. So we call that dollar cycling, which is one of the key components about how this program works. I get to use my dollar over and over and over and over again. Okay, so let's move forward. Let's talk about how this works in practice. So this is a family that I worked with back in October 2019. This is a mixed family. They had both been married before. The husband was 36. The wife was a little bit older. The wife at the time was a PhD student. She's now a PhD. She teaches at university now. But in that process of becoming a getting her PhD, she'd certainly built up a tremendous amount of student loan debt. Student loan debt's evil, evil, everybody, evil. Stay away from it. All right. So in this scenario, this is real. This is a live family. Because that student loan was scheduled for 40 years of payoff, that means their debt for 40 years, they were going to be paying on all these debts. And when we look at what their base debt was, 584,000 versus their true debt, which is what happens once we compute how much interest they're going to owe, they were at $750,000, and they thought they were at 585, right? And this is not abnormal. I see this all the time, and you will too once you start looking at these programs a lot. So if I had an opportunity to pay off all my debt at one time in this family, that means I would have to stroke a check for $585,000. If I had $585,000, I wouldn't be in debt. That's not the case. So we are taught from a very early age that debt's okay. That's the lie that we're all taught when we're growing up. And as we move through life, we take on more and more and more debt because we're making more and more and more money. That's the American way. Unfortunately, that's where the American way's gotten to. It is not the way we should be doing things. So when I showed this to the family and showed them their true debt, of course, their jaws dropped, big, deep breath. And then I showed them this. This is what we were able to do with them for a DFL program. We were able to take 40 years of debt and eliminate it in 7.8 years. And that you should all be having holy cow moments. This is not abnormal. We see this all the time. The truth of the matter is these programs, with the infinite banking concept, once you incorporate true debt snowballing, don't have any illusions. Okay. Debt stacking, paying off the highest interest rate first, then going to the next one, that's debt stacking. And that is not the most efficient way to do these things. So if you look at this, for example, this is a perfect example. The highest interest rate here is 25.24%. That is not the first thing we paid off. We paid off this care credit bill, the state taxes, this carpet bill. We paid off those bills first because this is the most efficient way to eliminate this debt. So how do we get to that efficiency? The most efficient way to eliminate debt with one of these programs is by maximizing the debt snowball, not debt stack, debt snowball. So in this case, this is the most efficient way. And there's only one way. There's only one best order to pay your debts off. And the software that we spend a lot of money to use, which is what created this illustration, shows us that one best way based on the interest rate, what you're paying, how much you owe. Okay. So we went from 40 years to 7.8 years, which means I got this family out of debt 32.2 years faster. That's a little bit more than my 15 to 27 average, but I'll take it. 32.2 years faster. All right. So now let's look at how the deep dive into how the program actually works. So, one more thing. Here you go. So we went from 40 years of debt out of debt in 7.8 years. We saved $70,000. That's a huge chunk of change. I'll take that. Give me 70 grand. More importantly, at the end of that 40-year run, if they stuck to this program and didn't do any other tricks that we have, but just did this program, they would have had 4.8 million liquid. Okay. Now look, that is an estimate. And I will also tell you that that estimate is low. And the reason why I'll show you on the next screen. All right. But more importantly, this also came with a death benefit. That death benefit was $1.1 million paid up. These people never have to pay another dime for their life insurance policy. It's all done. Okay. Moving forward, here's the magic, if there is magic. So we've got this program was based on the husband who was 36 years old at the time. You can see that first line, 36 years old. Every one of these yellow rows is a year where we pay off one or more debts. So let's look at how to read this. Okay. So in the first year, we took $14,900 from our bank, and we paid off $14,915 of debt in the first year. At the end of the year, we had paid back some of that debt to the point where we only owed $8,629. In addition to that, at the end, we had $12,000 sitting in our account. So we paid off 14, have a debt, so there's $6,000 there. Plus we got $9,000, and we got $12,000 left over at the end of the year. Okay. Year two, same deal. Paid off $15,000, paid off the rest of that first year's debt, paid off half of the second year's debt, and now we've got $40,000 liquid sitting in our account. You guys having holy cow moments? Hope so. Third year, here's where it really happens. When we look at the debt snowball, there's a consistent period of time when the debt snowball really picks up. When that little dog with the antler on the head starts rolling and you can't stop it, it becomes a juggernaut. Okay, so in that somewhere between the second and the third year is when that typically happens. Okay, so what does that mean? That means in the end of this year, by the end of this year, we have borrowed $58,500. Why are we borrowing that? Because we're paying off that debt. We paid off $58,500 worth of debt that year. We also paid off the balance of the second year's debt, and we paid off about $12,000 of the third year debt. And we still have $30,000, almost $30,000 sitting in our account. Holy cow, right? Now let's look at what happens in the fourth year. In the fourth year, we only have 3 debts left. We have their primary residence, we have their rental home, and we have the big student loan. That's it. So in the third year, the way this software illustrates, we're paying off debts in one shot. It doesn't have to be that way, but that's the way this software illustrates. So at the end of the third year, we've paid off that last big chunk from all the little debts. All the little debts are gone. We are not borrowing any money in the fourth year. Loan from CV, 0. We are paying down $31,000 of the previous year's debt. So we're down to $17,000 on the loan. But wait a minute. Now we have $91,000 sitting in our account. So can I get a collective holy cow? Holy cow, right? So moving on to the next year 5, now we're paying off a residence. We're going to borrow $96,000 from our program. We're going to pay off $96,500 of debt. We're going to pay off over the course of the year, what is that, $17,000? And then at the end of the year, after all that's happened, we still have $61,000 in our account. 6th year, paying off another loan. This is going to be the student loan. So in this year, you see this column over here, the savings column? This is one of those things we were talking about earlier, about having a second bank ready to go. In this scenario, there would have been cash built up in this column this year. In the third year, it would have been $7,486. That's where there's too much money going to the program, and our single policy cannot hold the money, or it would become a modified endowment contract. So we don't put the money in the program. We put it into a savings account, right? In this scenario, this column, this gray column, is illustrated with a 2% return. Why would I put money into a savings account earning 2% if you can get that, really? Why would I put money into a 2% return account when I can simply turn on that pre-bank from the other member of the family that we're going to insure? Start that term policy, the guaranteed, flip it into another one of these programs, and then start putting the money in there. Earn your 4% plus a dividend. So that's why when I show you this illustration about how much money we're going to have at specific times of the year in specific years, it's wrong. It's light. Okay, that's the good news, right? All right, so back to this. 6th year, we're borrowing $20,000 out of our savings account, $68,000 out of our private bank here. We have a total loan amount of $134,000, so we're paying back some of that, and at the end of the year, we still have $45,000 liquid sitting in our account. Okay, and if you're asking for a second, why did I just take the $45,000 also? The reason is because we take the money the way this is illustrated. We take the money when there's enough money to pay off the debt. Okay, so if that money to pay off the debt is in June, then by the end of the year, 6 more months, we've built back up. That's why there's this money in the account. Okay, next, 7th year, we take nothing, and we build up our cash value to $123,000. And then before year 8, which is actually year 7.8, which is why it's showing up in the 8th year here, we borrow $18,000 from our savings account, $117,000 from our private bank here, pay off all that debt, and we still have $75,000 liquid sitting in here. There should be another holy cow moment for you. Now look, this gentleman told me when he owns a trucking company, told me that when we were doing this program, his goal was he wants to buy a truck every 4 years, a new truck. Okay, and that the plan that we did for him is going to do that, certainly, but his trucks are $90,000. Okay, so if he was going to buy a 90,000 truck every year, what did this program do? Or every 4 years, he can now buy a $90,000 truck every year. This is going to increase the rate of growth of his business by 400%. Okay, so we're talking about all the different ways you can use this program. This is a private bank. This is a private debt-free life bank, but you can use it for other things and just get creative. The money's there. It's your money. Do what you want to do with it. Here's something I want to say though. Look at this column right here. Again, this is a savings balance column. So this number over here in the annual liquidity is based on the amount of money in your savings balance column plus the amount of money in your adjusted cash value. That's great. And also this emergency fund. So in this case, there's $140,000 for a year. When he's 57 years old, there'll be $140,000 sitting hidden. His total liquidity for that year is going to be $1,787. And that's if he didn't listen to me or listen to you. If he did not set up that pre-bank, because if he set up that pre-bank, he's going to get at least 2% higher return than what we're showing here. Okay, that's also if he didn't do any of those other tweaks that we talk about, the dollar cycling, the mortgage chunking, the annuity stacking, the escrow funding mechanism, those other things we talk about. So this is him. Instead of him retiring at 75 when he wanted to, we got him able to retire at 55 with $1.5 million cash. I don't know about any of you folks. I could certainly work with 1.5 million. That would probably be enough for me to retire on, because the interest on 1.5 million, as we're demonstrating here, is $136,000 a year. So not only would I have 1.5 million liquid, if I wanted to, if I just left it in the program and let it ride, I'd be making $136,000 a year. That's the gain, as illustrated here, which, as we said earlier, is light. Okay. Let's move on. So what if you don't have a debt like that? What if you don't own a home? All right. Here's an example. This is a college student that I worked with. She's a 23-year-old master's student right this minute, working on her master's. But before she left to go do her master's, she was $85,000 in debt. Car, student loans. Student loans are evil. Did we talk about that earlier? Student loans are evil, right? Student loans are evil. She's got a couple of cats, had to pay the vet bills, all that kind of stuff. It adds up, right? So what did we show her? Yeah, it's not $85,000 worth of debt. It's actually $177,000 worth of debt once you look at the interest that she's paying on all these things. So when I showed her this, of course, her mouth dropped, and she said, well, I don't want to do that. I know. So understand who this person is. She's a college student. She works as a waitress, okay? I've owned restaurants before. There's nothing wrong with waitressing. It's certainly a great way to make good money early on in life. Okay. We assume incorrectly, we assume that that's all she's ever going to do. We assume that she's never going to graduate from college. We assume that she's never going to get a better job. And she's all she's ever going to be able to do is afford $350 a month for this program. Okay. That's a critical assumption. We know that's not the case. So with our program, not only did we get her out of debt in less than 40 years, we got her out of debt in 30.3 years fast. Okay. We took that, eliminated $64,000 of the $95,000 interest she was going to be paying over time. That's huge. That's an extra year's income for her, right? More importantly, in 40 years, when she's 63 years old, she'll have $603,000 liquid in her account. That's if she never overfunds this, never does the maximum funding that we set up for her, never adds any extra cash from anywhere, and all she does is the basic $350 a month payment until she decides not to pay it anymore. And more importantly, if you look at, there's also a $400,000 death benefit. That's a legacy, I think, for a family, right? So this was her program. 10 years, over 10 years, we got 9.7 years, got it all eliminated, right? Same deal here though. We see years here where we've taken a loan, took a loan for $3,060 in year 2, paid $700 back, and then at the end of the year, I had $4,000 sitting in the account. And in year 3, not taking any loan because the next debt that we can see to pay off, the next debt is too large. It's larger than that number. So there isn't a time in the year where we're going to pay it off. And that's her schedule. So look, this had an RPU in it. it's reduced paid up. So what that means is that when this young woman turns 55 years old, she's never going to pay another penny for the program. It's going to be completely self-funded. The snowball has started, kicked in, and grown, become a juggernaut. And at 55 years old, if she wants, there'll be $409,000 minimum sitting in the program for her to do whatever she wants to do with. If she wants to close out the policy, that's what she's going to be able to access. Now, all of it does not come from that policy. If you see here, the savings balance, at least $190,000 is sitting in a savings account somewhere, earning 2%. Again, why earn 2 when you can earn 4 plus a dividend? So again, for her, obviously at 23 years old, well, you didn't know, she's not married yet. So there wasn't a spouse that we could start that second program on. But when she gets married, I guarantee you she's going to give me a call. I'm going to get an invite to that wedding, and we're going to go ahead and, as a wedding gift, we're going to go ahead and put one of these programs on her husband. Okay. So at the end, at 55 years old, she said she was going to work to 65. At 55, she'll have $409,000 in the bank. More importantly, look at that. From 409 to 431. So I grew from 409,000 to 431,000 in 1 year, and I made 0 contributions. You guys see that? 0 contributions. So what does that mean? That means that I just created a $22,000 per year income for her starting at age 55. More importantly, that income is tax exempt. So if you look at this and compare what the taxation on that would be to net $22,000, I'd have to be making $34,000, roughly. $34,000 to be able to recoup and have that kind of money coming into my account every year that I didn't have to pay tax on. So that's, her account is growing at that rate. She can let the account grow or she can take the loan. Either way, the end result, the delta is going to be the same. Okay. It's actually, she's still going to have growth even after that, because it's 17 out of 20 years, you're going to have positive growth on this thing, depending on the way that the market goes with the dividend. So that's the end of this presentation. So what do you do next? Next, at this point, you should get up with your whoever invited you, and you should go and have a conversation with them and potentially put one of these programs in place. So I'm gonna open it up at this time. It's 6:41. I got a few more minutes. The Knoppler has joined us. So if anybody has any questions, just go ahead and either raise your hand or unmute and ask away. Kaleo.
What's the oldest you've written one of these policies on?
74 years old.
74.
You can you can execute these up to age 75. Just FYI. All right, anybody else? Yes, sir. Mr. Samsung. You are well off, sir. I'm impressed.
It's Peter Asmus. Sorry, Scott.
Hey, Peter.
Is this only for debt reduction, or can you use it to pay regular expenses?
Right. So you can cycle through this. I have a certainly there are business applications of this program where you could run like all of your business expenses through the month into this. Instead of paying your expense first, pay this first, and then pull the money out and pay the expenses. So you can cycle through the money that way. It's a little bit of a different illustration that you have to do. You're not going to be able to use the DFL, the DMA report that we get from YFB. It's not going to show you that. It's a little bit more work to illustrate that, and it's not dollar for dollar. So if you have, like, let's say your monthly living expenses are $5,000. The program will not work if you're only putting $5,000 into it, okay? Because you don't have access to 100% of your money all the time unless you close out the program. If you close out the program, then you're done. So realistically, you should look at a 90% level. So if your goal is to be able to pull out $5,000 a month, you need to be putting in 1.1 times that. So $5,500 a month would give you, so that you have a 0, okay? There is a danger, however, because remember I said 17 out of 20 years you're going to have a gain. There's a danger that those 3 years you don't have a gain. And if you're trying to run the program so close to 0 that those 3 years you're going to have a problem. So you really need to be even more than that to make sure that you can make up for those 3 years out of 20 where you're not going to have that gain. Okay, good question.
One more.
Right.
What would be the negatives to this?
So the negative to this is, the only one I've ever found is that all of a sudden, most of the people that execute these programs typically don't have access to large sums of money with regularity. and the temptation to go out and buy, and I was joking about the emergency jet ski, but it's there. The temptation to go out and buy that new toy, or to go spend that thing, it's easy for that demon on the left side of your shoulder to say, you worked really hard this year, you deserve something, go out and buy that blah, whatever it is. That's the danger. And if you do that, then you're not executing the program the way that the program is designed, which means you are not going to have the result the program says, and you can derail the whole.
Gotcha.
If you spend money, so spending money on stupid stuff is the danger. Okay.
Gotcha.
Until you're in the last phase, the distribution phase, and at that point there is no stupid stuff.
Right. You just got to be patient.
There you go. All right.
That's awesome, Scott. Appreciate it.
Yeah, man.
That's so awesome.
I got Peter and then Lorene, and then we're gonna get going.
Okay, can you start off by inputting a lot of cash to start off with and immediately pay off some debts?
I have a program that we issued 2 weeks ago, and the gentleman contacted me today. He's going to be dumping $60,000 in today and $60,000 in tomorrow. So the answer to your question is yes, you can overfund it. And when you're looking at programs like this, especially with a company like Mutual Trust that affords you the opportunity to have monthly compounding, the earlier in the program you maximize your PUA bank, the better off you're going to be. So whenever I have people that have one of these programs, I'm going to tell them if they have the capacity to overfund it on day one, do it. Even if it's put in the money on day one and pull it out a week later, just get the money in the program, get it working for you as quickly as you can. Does that answer your question?
Yes, it did. Sorry, I put myself back on mute.
All right, and Lorene Breitkreutz.
On the tail end of Peter's question is, if someone wanted to do that with their monthly expenditures, where would I go to learn about how to illustrate this for them? Would I go to, you can't?
Can't illustrate it, not with the DMA software, the DMR software. The way I have to illustrate that for people is I create a spreadsheet, a personalized spreadsheet. So you have to have, and it's not pretty, but but the numbers are, we don't care about pretty. We're just looking at numbers.
Right. Okay.
Yep. All right. 646. Got to get rolling here. Hold on. There's 4 things in the chat. Primary rule for a successful path to retirement is to pay yourself first. Right on, Mark Creighton. Okay. Holy cow, mind blowing. There you go, Kaleo. All right, Mark. And 3 days or longer, even if it's a cashier's check. Right. All right, very good. So thank you, everybody, for coming. Hopefully you got something out of this. For those of you that are Symmetry agents, we're going to be starting a Debt-Free Life A to Z training here in about 13 minutes. So see you guys later. See you next. Oh, one more thing. Next week, hold on, let me stop this recording.